Hello students, in today's session we are going to learn about accounting principles. Accounting principles are the guidelines, rules, policies related to all the recording of transactions happening worldwide related to business. So, knowing accounting principle is of utmost importance for all the business around the world. So, in this session, what we are going to learn? We are going to learn about what accounting principles are, what are the various types of accounting principles we have, then we'll learn about accounting concepts and accounting conventions. Introduction to accounting principle means what accounting principle is all about. Accounting principles are the basic guidelines and rules that form the foundation of financial accounting. Means what we are learning or what we are seeing in business in recording of transactions, it has to follow the accounting principle. Accounting principle provides a base, it provides a basic guideline and rule that how we are recording all the transactions. What it ensures? It ensures consistency, reliability and comparability of financial information. These are the principles which provide us with a basic backbone of all recording of transactions in a business. So, these principles are followed globally, worldwide. Every single organization or business working around has to follow the accounting principles. So, forming with the base of GAAP, that is generally accepted accounting principles, these accounting principles are formed. So, let's see that what are the various types of accounting principles we have. We have two types of accounting principles. The first one is accounting concepts, which are created based on assumption and ideas. Second is accounting conventions, which are developed based on practices and uses or how the custom, particularly a business, is providing. So, there are two types of accounting principles, accounting concepts and accounting conventions. There are accounting standards as well, which is covered through accounting principles, but we will be mainly focusing on accounting concepts and conventions. So, let's start with accounting concepts. Accounting concepts are formed on the basis of recording transaction. Means when the transactions are recorded, what set of rules it should follow, it is given under accounting concept. They maintain consistency and uniformity so that we are not changing how we record a transaction again and again. It provides us that consistency, it provides us the uniformity. So, accounting concepts are the basis how we want to record the transactions. There are 9 accounting concepts are there. What are those 9 concepts? Business entity concept, money measurement concept, going concern concept, accounting period concept, dual aspect concept, cost concept, realization concept, matching concept and objectivity concept. We will learn about all these concepts one by one. So, let's start with business entity concept. The business is treated as a separate from its owner. Why it is being separated from the owner? We treat business as a separate individual. We give business its own identity, and owner's identity who has started the business will be different from the company or the business's identity. For example, let's say Ram has started a business named as RS Enterprises. Now, RS Enterprises will have a separate identity than Ram. Ram may be the owner, but RS enterprise will be treated as a separate individual, a separate identity will be created for it. That's why we say that business gets its own entity, and this concept tells that like a individual, like Ram has its own land, building, property, cash, everything, the business is also going to have its own share of land, property, cash, all the assets and liabilities, how a particular living a person also has. So the transactions which we are recording in the accounts will be from the point of view of business, but not from the owner, because now business is a separate individual. Any type of money which is given from the owner to the business will be considered as a liability, will be considered as a loan for the business. It will be not considered from the point of view of owner. So if the business is buying a land, it will be that business's asset, not the owner's asset. So in business entity concept, what we have understood, that a business will have a separate identity from its owner. Owner will have a separate entity and the business will be a separate entity. Next, we have money measurement concept. Money measurement concept gives us a rule or guideline about the transactions which we are recording should be based on money. Means only those transactions which can be measured in financial terms, only those transactions which can be measured in monetary terms will be recorded in the books of account. Anything which is of non-monetary nature will not be recorded in the books. For example, we bought a furniture. Now furniture can be measured in terms of money. We pay 10,000 for furniture, so we can measure it in terms of money. It can be recorded in the books. But a skill of labor, how skilled a labor is, or what reputation a particular manager is holding, these things cannot be measured in terms of money. Can we measure the skill in money? We cannot. So these type of transactions where we are unable to identify the money aspect related, we cannot record in our books. So money measurement concept clearly tells us anything which is measured in money or financial terms can be recorded in the books, and anything which is of non-monetary nature should be excluded to enter in the book. Next, going concern concept. Going concern concept assumes that the business is going to run till the end of the time, means it doesn't have a specific time to end. Business will keep on going till the owners decide to shut down the business. So it assumes that business will continue its operation till an indefinite period of time. So all the assets which are valued in the business will be valued at cost, not at liquidation value. Means how we are disposing a asset, or how, when we are selling, at what price we are selling, that will not be of any concern while we record the asset in our books. It will be recorded based on what, how much cost we have given, because we don't know that how long that particular asset is going to work for us, because business is running for indefinite period of time. The asset can also work for years for us, right? For example, a machinery is shown at a depreciated value, not at resale value. So when we are recording a machine in our books, we will record at depreciated value, means with the wear and tear, how the value of machinery is going down over a period of time, we will record that, but we cannot record at what price we are selling it. So machinery will be shown at a depreciated value, not at resale value. It assumes that the business will continue its operation till the end of time. Next, accounting period concept. Now as we know that business doesn't have a definite period of time to end, so are we going to wait till the business ends to understand that how much profit or loss we have got, or what is the financial position of the business? We cannot wait that long and we cannot get an accurate figure as well. That is why the whole term of the business is divided in various accounting periods. So it is divided yearly, quarterly or half yearly. In those periods it is divided. So the whole life of business is divided into specific time periods, and mainly one financial year is calculated. At the end of a particular financial period, the profits and losses are calculated. These financial period we can say from January to December or from April to March. How a particular business wants to calculate its year, it can calculate based on its own will. It can be from January to December or can be from April to March, but the whole life of business will be divided into specific time periods. So dividing it into particular time period helps us determine, helps us understand whether our business is going up, going down, how much profits we are earning, what losses we are incurring, or any kind of changes we want to make in our business can be done based on this time specific reports. Next, dual aspect concept. Dual aspect concept speaks about every transaction being recorded in two areas, one debit, one credit. Means every transaction having dual impact. One thing is going to be debited, another thing going to be credited. Okay, it creates the system of double entry system or double entry bookkeeping, we can say. Let's understand this with one example. Let's say we purchased a machinery for cash. That means the machinery is coming into the business, and when we are purchasing a machinery, of course the cash will go out of the business. That means one thing is coming in, another thing is going out. So machinery will be debited, cash will be credited. So we have seen that how one transaction, that is a purchase of machinery, has created a dual aspect. One thing being debited, another thing being credited. So dual aspect says that every transaction will have dual impact. If any transaction is not creating dual impact, that means we are making some mistake somewhere, and our accounts are going to show a faulty result if dual aspect concept is not followed. Next one, we have cost concept. Cost concept tells us about how we want to record the transaction, means what value we should consider. Now everything has different value. One value at which we buy, one value with the time how it's being depreciated, how we are using it, so the value of the thing is going to go down, and the third value in which the market currently is dealing with the asset. Let's understand with one example. Let's say you bought a mobile phone for rupees 10,000. So the money you have paid to the shopkeeper is 10,000. You used the phone for a year, so of course after a year the value of the phone is going to go down. It might go down to 5,000 or 6,000. Let's say 6,000. That means the current value of the phone after you made use of the phone is currently 6,000. But at the time you went to buy it to someone, they are ready to pay only 4,000 of it, or 8,000 for it, any price. So what cost you are going to assume to record in the books? There is a confusion that there are so many different costs associated with the particular item, which cost should be recorded. So this cost concept clears out this doubt and tells that only the amount which we have paid for acquiring that asset will be recorded. Means if we have paid 10,000 for the phone, we are going to record it for 10,000, but every year with the use of the asset we can depreciate the value, but we are not going to assume or we are not going to record the market value of the particular item, because the amount which we have paid is the actual amount which we have to record. Why it is necessary? It ensures the objectivity and prevents any manipulation, because now market value of that asset may be different for different people. One person is ready to buy the phone for 4,000, the other one is ready to buy for 6,000. So it depends on person to person, which creates confusion. So any kind of manipulation can be prevented if we follow the cost concept and record the item with the cost which we have paid to acquire it. Next one is realization concept. Realization concept talks about recording a transaction as and when it occurs, not when it is actually received. What it means? It means that any kind of revenue which is generated, whether it's received or not, can be recorded as and when it is earned or realized. For example, you made a sale on credit. You sold goods worth rupees 10,000 to ABC Limited, but they have not paid the amount yet. So when you will record the transaction, when you are going to receive the amount? No, we are going to record the transaction when we have made the sales, when the revenue is realized. The revenue is realized today because we made the sale today. So we are going to record it today that we made a sale on credit, and whenever we are going to receive the money, that transaction will be recorded separately. We will not wait till the date the amount is received. Realization concept clearly tells as and when a transaction takes place, mainly towards the revenue recognition, it should be recorded without waiting for the amount to be generated. So we are recording the revenue when it is earned and realized. We are not going to wait till the cash received. Next concept is matching concept. Matching concept talks about that all our expenses, whatever expenses we are making, it should match with the revenue which we have got in this year. Means whatever amount which we have spent to earn the revenue should match. If we have spent 10,000, then the revenue should show that we have spent rupees 10,000 to earn that revenue. So when we are matching our expenses with the revenue, we exactly know to earn a revenue of 15,000 how much expenses we have made. So it ensures correct determination of profit and loss. It helps us identify whether we have got the profit or the losses, and it determines in a specific accounting period. Means in this particular year, if we have revenue of 10,000, against that revenue of 10,000 how much expenses we have made, then only we can calculate the profit or loss. This is what matching concept is, matching our expenses with the revenues in a particular time period, in a particular accounting period. And the last concept is objectivity concept. Objectivity concept talks about the evidences. It talks about verifiable proofs, verifiable evidences rather than personal judgment or opinion. Means if we have purchased a machinery worth 5 lakh, then there should be a invoice stating that we have purchased a machinery worth 5 lakh. we are not going to record a transaction based on the accountant or manager's estimation, but there should be a legal verifiable evidence which talks about the transaction taking place. Now with this we are done with our accounting concepts. Let's move to accounting conventions. Conventions are customary practices that accountants follow over a period of time. So these are customary practices. There are 4 major conventions which are being followed under accounting. The first one is consistency, full disclosure, conservatism and materiality. Let's go with these one by one. The first one, convention of consistency. The convention of consistency talks about following the same accounting method and practices year after year. Means if we are following a particular method of calculating our goodwill or calculating depreciation, we should follow it year by year. We should not change it very frequently. We should not change it. This year we are following a straight line method, another year we are following written down method, and again we switched back to simple single method. Then it is not going to work in a particular way for business, and it is going to create the confusion for the comparison, and it will not create the consistency. So convention of consistency talks about that whatever methods we are following in the business, it should be followed the same way year after year, and if we want to make any changes, we should state down the reason of it, and henceforth that method will be followed for again a particular set of years. It ensures comparability in the financial statements. Next one, convention of full disclosure. The convention of full disclosure talks about all material facts should be fully disclosed in the financial statement. We should not conceal or hide any financial information from our stakeholders. All the accounting transactions should be fully disclosed to all the stakeholders who have a slightest of interest in knowing our financial position or how we run our business. It creates the transparency and trust among the users of our financial information. So all the information should be fully disclosed. We should not conceal or hide any information from our stakeholders. The third convention is convention of conservatism. It is also called as prudence. What it means? Every business has to be prepared for the contingencies or losses that may occur in future. Means if business can anticipate that a particular type of loss may occur in the future, then they should be prepared for the loss beforehand. For example, if a business knows that a set of debtors are not going to pay in future, they might get insolvent, then a provision to deal with the debtors should be created, named as provision for doubtful debts. Means they already created a provision for any kind of loss which might happen. So convention of conservatism, what it tells? It tells that we should be ready for any future losses. We should anticipate it and be ready for it by creating any the provision or reserves for the same. The last convention we have is convention of materiality. Materiality talks about we only recording the transactions which are material to the business, means which are important to be recorded. Any small expenses, any small losses should not be recorded as an individual item. It can be clubbed together as miscellaneous, or it should be clubbed as a general purpose. So convention of materiality talks about that we should only record material transaction. Now let's understand it with one example. We bought one machine for rupees 10,000. Now the amount is big and machinery is big, we should record it separately. But if we have spending throughout the year for buying stapler, pens, pencil, eraser, are we going to record it pencil amount separately, eraser amount separately, pens amount separately? No. We can club all these items under stationery and the total amount can be put in our records. So, convention of materiality talks about only recording the facts and transactions which are important and material, and all other expenses and items can be clubbed together to form one important one. Now, to conclude, what we can say that accounting principles are created as a universal language for business and accounting. It makes the financial information meaningful, comparable and reliable. Following these principles is essential for all ethical financial reporting. So, in accounting principles, we learnt about accounting concepts and accounting conventions. There are 9 accounting concepts and 4 accounting conventions. Those 9 accounting concepts are business entity concept, money measurement concept, going concern concept, accounting period concept, dual aspect concept, cost concept, realization concept, matching concept and objectivity concept. And in accounting conventions, we discussed about convention of consistency, convention of full disclosure, convention of conservatism and convention of materiality. Following all these accounting concepts and conventions, we can say that these are providing us with a set of guidelines and rules through which we can run our business and we can compare our financial transactions with our competitors and with our own financial transaction recorded over a period of time, so that we are taking the right decision for our business and we are following the global standards. So, with this we have understood what accounting principles are and how these accounting principles helps us in running our businesses. So, these accounting principles are providing us the base of how we run our business and how we can create a system of transparency, create a system of consistency in running or recording our financial transactions. How we treat our business separate from the owner. How we record it that every entry has dual concept, debit and credit. It also tells us that what is important for our business, what is not important for our business to record, how we are going to estimate our profits and losses, how we are going to divide the whole life of our business into different time period. So, knowing all these helps our business comparable, globally accepted and which can grow when it comes for the future of our business. So, our business becomes more transparent, reliable, consistent and comparable. So, we know that our accounting principles, it is worldwide followed, it is global and depends on the generally accepted accounting principles of GAAP. So, with this we understood our accounting principles clearly.